So this is the start of chapter 20, which is all about leases. So when you're going through this chapter, think of yourself about if you've leased a car or if you were going to lease a car. Because sometimes it's easier to picture some of the scenarios, like when you go to lease a car, who determines the lease price? Is it you, the lessee, or the car owner, the lessor? That kind of thing. So that's just something to keep in mind. So leasing's popular, cost-effective way of financing property and equipment. So a lease is a contractual agreement between the lessor, the company who owns the asset, and the lessee, the company who is using the asset. So the lessor would be Ford or whoever, Toyota, and if you were leasing the car from them, you'd be the lessee. So you can think of it that way. A lease gives lessee the right to use the asset or the property. It also has a duration, so it'll be for 5 years, 3 years, whatever, and then some kind of rental or lease payments. The obligations for taxes, insurance, maintenance, and stuff can either be assumed by the lessor, the owner, or the lessee, or divided between the two parties. So, for example, you lease a car, you're paying the insurance on it, so the lessee is paying the insurance. Okay? Question that arises is, in accounting, how should we treat the lease? Should we just put like rental expense or lease expense every month and leave it at that? Or do we have to do something more? And when we think of ourselves just leasing a car, maybe it's not such a big deal. But think of it this way. So if an airline actually borrowed $80 million on a 10-year note to buy a jet, and maybe they wouldn't buy Boeing anymore, but they'd buy some jet, there's going to be an asset and a liability recorded. Right? So the note payable and the jet would be an asset. If they purchase the jet directly from Boeing through an installment purchase over 10 years, then again, an asset and a liability are recorded. However, in the past, when leases first came out, what they do is say, well, it's just rental. But if the leases the jet for 10 years, so it's 10 years, it's non-cancelable, so halfway through they can't go, we're not doing it. Okay, except if the planes start crashing. Okay, a whole different idea. And the payments are approximately equal to the payments on the installment sale. Shouldn't the company who's leasing that jet have an asset and liability recorded, just like the companies in the first two examples? So there's 3 views of how a lease should be treated. So don't capitalize any leased assets, and that's called an executory contract approach. And that, if you think of you've heard of balance sheet financing, that would be it. Or you could capitalize leases that are similar to installment purchases. So you kind of classify each one, you have a little checklist, and you check them all off, and if they all are, then you put it as capital. Or you capitalize all long-term leases. So a contract-based approach. So you're focusing more on the contract. So generally, we've got IFRS for the lessee. And here we have ASPE for both. But IFRS is for the lessor. So in the past, just so you know, everybody kind of went with classification, but this is new for IFRS in the last 5 years, and it's all the contract based. I think what they're trying to do, I know what they're trying to do is standardize it. Remember, IFRS is through the whole world, so that when you're comparing one company's balance sheet to another, you know that if they are leasing, you're going to have an asset and a liability. So the view is lease contracts create assets and liabilities that should be recognized. Almost all leases would be capitalized. Now, there are two exceptions to this. And if you look on page 2, under IFRS, from the lessee standpoint, sorry about the focusing, all leases are capitalized and placed on the statement of financial position except leases for a term of 12 months or less, so it's a short-term lease, or the underlying asset is of low value, so low materiality. So this is an or situation. So if it was, it would be an operating lease, which is just like what we'd call a rental in past accounting courses. You can see example 20.3 in the text if you want to look at that, but we will talk about that later. So if a lease is not capitalized, and capitalized of course means putting it on the balance sheet, the lessee recognizes the lease payments as an expense on a straight line basis over the lease term, or some other systematic approach that applies. So our classification criteria from the lessee's standpoint, so the person that would be leasing the car, under IFRS 16, which is new, check if each contract they enter into a lease, it is if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration or money. Instead of a period of time such as months or years, a lease can also be described by the extent of the use of the asset. So maybe your lease term for an automobile would be, 100,000 kilometers, for example. Or if you've got manufacturing equipment, maybe it's 200,000 units or something. The objective is for the financial statements to represent faithfully the effect of leases on the company's financial position, income, and cash flows. Now, from the lessor's standpoint, so the people that actually own the asset, it's essentially the same as under the old standard, which the classification approach is used. So that's number 2 on page 1, whereas this is number 3 on page 1. And leases are categorized as a financing lease if it transfers the risks and rewards of ownership to the lessee. And ASPE also follows this. It's very similar to the IFRS, and we'll talk about that later. So moving along, there's a little bit of terminology you kind of have to get used to. So on page 3, we'll go through some of that. Okay. So we'll be talking about when you're calculating what to capitalize, the present value of minimum lease or rental payments, so MLP, for the lessee is defined as follows. So this is the amount to capitalize. So put on the balance sheet. We take the present value of the minimum lease payments plus the present value of any amounts guaranteed. For example, a residual value. Plus, we take the present value of the bargain purchase option, and that gives the value of the right to use asset, so that's the asset, and the lease liability for IFRS, or the amount to be capitalized for ASPE. So there's an asset and a liability for all of the leases that are non-operating. Operating would just be a rental. Now, if the residual value, and residual value is just the amount the asset is worth at the end of the lease. If the residual value is guaranteed by the lessee. So let's say you were leasing a car and you said, you signed the lease and it said the residual value, you will guarantee when you return the car, will be worth, I don't know, $10,000. Really hard isn't the right word. You know, you let your dogs play in it, you drove it really hard and pulled your trailer, and the trailer was a little heavier than it should be, that kind of thing. You wore it down a lot. That would mean if it was guaranteed, if you took it back and they, you know what, you really wrecked the car, it's worth $3,000, and guaranteed 10, you'd have to come up with the other 7. Anyway, so if it's guaranteed by the lessee, the present value is included in the leased asset and lease obligation recognized. So up here. So in this instance, when we're saying it's guaranteed like that, we're expecting you to return the car to the lessor. So you're only going to depreciate the capitalized amount less the guaranteed residual amount. But if the residual value is unguaranteed, it's not included in the lease asset and lease recognized by the lessee. And again, you guys are going to go through an example and we'll talk about all of these step by step, so don't panic yet, it's a lot of new words. Okay, minimum rental lease payments. That's called a regular payment made to the lessor. Now it excludes executory costs, and those are those costs we talked about earlier, insurance, maintenance, tax, that kind of stuff. If these that owned it originally, the lessor, they're estimated and excluded from the present value of the minimum rent payment calculation. Now, guaranteed amounts, guaranteed residual value, we've already talked about it. Guaranteed value of the leased asset at the end of the lease. For the lessee, it's the maximum amount the lessor can require you to pay at the end of the lease. Now, a bargain purchase option we haven't talked about yet. That's the option to purchase the leased asset at the end of the lease at a price below the expected fair value. That's why it's called a bargain purchase. If it's included as part of a lease, only the minimum lease payments and the bargain purchase option are included in the definition of minimum payments. And again, you guys, we're going to look at the examples, kind of like all the rules to follow, okay? The discount rate is the incremental borrowing rate. The rate the lessee would have incurred if they would have had to borrow the money, purchase the asset under similar terms and similar security. The rate implicit in the lease. The rate that makes the present value of the minimum lease payments plus the unguaranteed residual values equal to the fair value of the leased asset. That's very nice. You just want to know which interest rate should you use. If you're doing it for IFRS, use the rate implicit in the lease if it is reasonably determined. So if it's known, the lessor sets the rate. Okay, so for example, again, with leasing a car, they might not come right out and say what the rate is that they've worked out to give you the payments you have. So the question will either say the implicit in the lease is 9%, or it won't say it. Under PE gap, I don't know why this says that. You should just scratch that out and put ASPE, please. Use the lower of the two rates. So lessee or lessor. Now, in terms of determining the lease payments, who does it? If you lease a car, is it you or the company you're leasing from? Well, it's the lessor. They set the rental payments to have a specific rate. That's that implicit rate we were talking about. If the lease has a BPO, bargain purchase option, or residual value, whether it's guaranteed by the lessor or not, then those components don't need to be recovered through the payments. So you're sitting there as a lessor, and you're going, okay, I'm going to lease this asset. I want to recover as much as I can, but I don't need to recover any residual value, because when I get it back, I'll just sell it for $10,000 or whatever it's worth. Or if there's a bargain purchase option, I don't need to cover that because they're going to pay me that amount. Then I'm not going to try and recover that through the rental or lease payments. Notice when you're going through this, you guys, if they talk about the rental payments, that doesn't mean it's an operating lease, okay? An operating lease would be one we don't capitalize. I'm going to put a note here. Note, rental payment in question does not mean it's an operating lease that's not capitalized.